So just to start, obviously everyone talks about not-for-profits and particularly in the finance area. We believe this is actually a misunderstood and wrong term in lots of ways, because there's nothing wrong with associations making, I'll call it a surplus, because particularly in COVID times, it's not bad to have a surplus to use during those times. Plus also if you've got big projects coming up for IT projects or marketing projects, it's good to have a surplus available to use. That way you don't feel obligated to barely survive. Well, associations don't distribute any of their money and they're more around serving their members. Reasonable expenses can be reimbursed in associations, and it's always acceptable that anyone that works and helps the association in a volunteer role or in a permanent or temporary role should be reimbursed for the costs that they incurred. You don't want anyone being out of pocket for helping the organisation. The Constitution needs to be very clear on what happens with things that are, if they're in the event of the organisation being wound up. And Kathy does a great amount of work in that area on constitutions and making sure that's in place. And usually what will happen is it'll have terms and conditions where if the organisation ceases, funds are transferred to a like-minded organisation, whether that be another social club, another golf club, or another association. So very important that the Constitution includes that. You need, as I said, to have adequate financial reserves, such as the COVID situation or something that's unexpected. During this period of COVID, and we've found that lots of organisations have had to diversify their income because they can't rely purely on events. With most events being cancelled, there's actually a big change to Zoom and other means and seminars and presentations. So very important to have diversification. Okay, key word in all of the finance presentations is good financial governance. A key to this is actually presenting a history of an organisation, because then you can actually see how where the organisation has come from and where it's heading. So what we encourage people to have that information readily at hand and updated, and also adding a budget or forecast column in where appropriate. These are very important history requirements because an incoming board member or committee member gets an idea of where the organisation has come from and where it's heading to. Despite associations being very limited in staffing and resources, we need to maintain a high level of financial reporting to ensure that we adhere to any of the reporting requirements by government authorities. Budgets must be set and the plans must follow those budgets. And usually what you'll find in board meetings or committee meetings, the budget items and the plans will be addressed by the agenda, and there'll be comments on how you're comparing and progressing against those plans. Really important. We've done a lot of work implementing finance, audit and risk committees for associations because they provide another level of governance to an organisation and provide particularly a finance expertise within that committee. So these might be only committees of 2 to 3 people. Usually it's 1 or 2 board members and a finance person on that committee. And we encourage that the chair of the board isn't the chair of the finance and audit committee. They actually have that independence and separation. The CEO would be an invitee to those audit and risk committee, as would any other management or executive team members. When you have all this sort of information in place, it's very good to report back to your staff members on how each board meeting goes within the levels of confidentiality, so that they actually get buy-in and understanding where the organisation is progressing. And lastly, if you're looking to do many major investments or other really important decisions that involve significant resources, it's good to get professional advice. Our attitude towards and skills for finance matters, we obviously encourage boards to be trained and staff to be trained on governance responsibilities. And that's why we have a lot of courses available to people, particularly new board members. But we find also existing board members usually take the opportunity because they need an update and they haven't had it for a number of years. We give information not only in governments, but we also provide this finance fundamentals to lots of organisations, providing knowledge and principles in finance. We also have available through Associations Forum a financial benchmarking system. So if you're interested in that, Kathy can provide that details for you as well. What I'd also stress in your reporting is boards need to know lots of summary information, if you'd like to call it. They don't need to get down into the detail and in material items. They don't want to know that you spent $100 on a photocopier, but they would like to understand what the latest marketing campaign has produced, or if you're buying into a significant IT project. We've seen in some of the cases we'll talk about later where boards were inundated with immaterial information that then disguised how the organisation was poorly functioning. Okay. In respect to accounting and bookkeeping, obviously the key items are a balance sheet and profit and loss statement. We also encourage what's called activity-based costing or cost centre reporting, where you look at a cost centre, say, as a marketing cost centre or a HR cost centre or a sales cost centre. So you actually understand each of those different cost areas that make up the ultimate profit and loss. Or as we've said, the board needs to understand the big picture. So it's logical the key assumptions within the budget are explained and agreed to with the board, usually at a planning day. Really important to make sure you put in place a planning day at the beginning of each period. We're finding that quarterly reports go to board, and we're also finding a lot more monthly reporting. During COVID, there was a lot more financial forecasting, particularly on people's organisations' cash reserves. And I'll talk a little bit later about accrual accounting versus cash accounting. Accrual accounting actually allows you to allocate income or expenses in a matching principle. It's one of the unique accounting terms, but you shouldn't be fazed by it, and I'll do a brief explanation further on that. So the key items within the financial statements are obviously the income statement, how the organisation is performing, the balance sheet, which basically shows an as-at position of the assets and liabilities of the organisation, the statement of cash flows, which is showing how you've spent and received your cash incomes and expenses, and the statement of any changes in your equity, which is your profit and loss statement and reserves. Breaking these up a little bit further, the income statement is obviously income, the profit and loss, profit actually equals income less expenses, and obviously you have a surplus or deficit. Revenue would include membership subscriptions, events revenue that you achieve, interest income on any investments you have. They're the key items, and you might have at various times other revenue streams. Expenses include obviously your cost of running the business, and that might be employee costs, the costs of any materials, and also the costs and depreciation of assets or equipment. So depreciation is a non-cash item. It's actually in the cost of running the business within the P&L. The key things to do in your reporting of the income statement is probably look at any material variances. And what you'll usually compare is a material variances somewhere between 5 and 10% or greater. And that will be comparing it against the previous year or against the budget you've established. That should be the key items. As I said, you don't want to see any reporting on something that's $1,000 different, but if something's $50,000 different and 20%, you probably want to know about that. In the balance sheet, it's a snapshot at a particular point in time. So some organisations will be a 30th of June balance date. So it's the assets and liabilities that they have in place at 30th of June, or in other organisations, it might be 31st of December. And it gives you an idea of what the resources of the organisation are going forward and what assets you can draw on and what liabilities are coming up in the next 12 months or in the following 12 months. So the current assets will normally include your cash and all the bank that you hold in the various accounts you have. It'll have the accounts receivable or debtors that you've collected or about to collect. It'll have stock or inventory. So it's everything that's usually convertible in 12 months into a cash item and be used in the organisation. It's important that you make sure you don't have accounts receivable where the debtors are more than 30 days overdue. And that would be another good reporting page to include in your board pack, the aging of each of your debtors. If the majority of them are current and are less than 30 days in payment terms, that's a good situation. You do get into trouble when you start to get debtors stretching out over 90 days. And that might then result in a need for you to actually write off those assets, or the auditors will ask you at least to put a provision against them in the balance sheet, showing that they may or may not be collectible. As I said, the longer they stretch out, the less likely they're collectible. In respect to non-current assets, this is your big, large physical assets, and that'll be your property, land and buildings, your plant and equipment, and if you've got any long-term investments in place that you're not looking to convert into cash within the next 12 months. In respect to current liabilities, these would include your accounts payable or trade creditors. And they, again, with those, you actually need to be very on top of them and make sure you have the cash available to pay them. Obviously, you want to collect your debtors quicker than you actually make your payables. So it's key to make sure you actually stretch out your payables when you enter into terms and conditions. With a supplier, it's best not to go to terms that are 7 days or 14 days. I'd encourage you to go to 30-day terms, so it gives you a bit of a buffer between your collections and your payments. Within that, you might also have some short-term bank loans where items are repayable within 12 months. And also you'll have those employee entitlements that are going to be paid within the next 12 months, and those that are not going to be paid as leave or long service leave or annual leave would be included in non-current liabilities, along with long-term debtors and long-term loans. And these ones would usually be ones where you've provided security over your assets and you're paying them back in a 5 to 10 year arrangement. So that's very important to have more non-current liabilities than current if possible, because then they're not due in the next 12 months. So as we've touched on, the cash flow is really how you've actually spent your cash or received your cash in during the year. Your receipts would probably include things from interest income, any dividends if you have any investments, and all the payments you received from your particular providing your resources, or the receipts that you receive from your membership. The outgoings or payments, they would include payments to suppliers, payments to employees, and also payments on borrowings, so your interest payments that you need to pay to service your loans. In respect to the changes in equity, this is just the movement in retained earnings between your last year's retained earnings, current year profit, and your closing equity. The key things we always ask in respect to these items is that each of the 4 items is, did the organisation make a profit? In some periods, you may not make a profit, might be a timing issue, but we always be looking to ensure that you do make profits over a reasonable time frame, and you have a trend towards more profits than losses, because ultimately you might have solvency issues if you're making extended years of losses. The other one we've touched on is the 10% variation in expenses. Also, it's looking for any unusual expenses that you haven't paid in previous years that have all of a sudden presented themselves. That might include write-off of assets, write-off intangibles. If you have to write on anything off because circumstances have changed, they would need to be reported because they're of an unusual nature, and they mightn't be always within your normal trading terms. So very important that you explain any unusual items, and that also gives the directors an opportunity how to address those unusual items and ensure they're not repeated. Important, as we've touched on, is to make sure that the organisation has sufficient levels of cash, and make sure that cash is actually growing if possible against previous years, because that'll be representing that the organisation is growing as well. And certainly you always need to have enough cash to cover at least the short to medium term, so you don't have any run on your resources. Also, the organisation needs to be ensured that it doesn't have a material amount of debt. in relation to the assets, because generally you probably need to secure debts against assets. And if you get too much debt involved, that will cause you problems in servicing that debt. And as we've said, you need to make sure that the debt is actually spread over a time period rather than being due all at the one time. And lastly, the key one, which is that any financial presentation talks about, is making sure the organizer is solvent. And the key question in that area as a director or an officer is the ability to pay the debts as and when they fall due from the organization's point of view.
Steve, we have a question on insolvency and the balance sheet. So if current liabilities are in excess of current assets, are you technically transiently insolvent because you have to liquidate assets?
You're not insolvent if the basis of your non-current assets is convertible into cash, and quite often you might have longer term investments in place. You might have stock exchange listed investments in place, so you probably should take those into account. If you believe that you can't convert them in a reasonable time frame, then you need to talk to the auditors and have a discussion around your solvency. So it's not just purely the definition of current liabilities versus current assets. It's actually what cash would be available to you in that case. So you'd certainly take into account some of those non-current assets if you needed to convert them into current assets and actually realize the value of those. Okay. Does that satisfy that question? Sorry. Yep.
Yes, there's no follow-up comments. So yes, thank you.
Okay, and that's good timing, that question, because the balance sheet is critical. So we need to make sure we have cash, and the cash is reconciled in bank statements. So the auditors, obviously, when they come in to do an audit, will actually look at what the reconciliation is of cash held at bank, and you will usually look at the bank statements. And the Finance Audit Committee is ultimately responsible for this and then reports back to the board. Also, what debts are owed to the association, and as we've touched on, will they be ultimately paid? Because it's no point in having a large number of debts and clearly they're not going to be repaid. So it's important that you understand what's realizable, and as I said, not extending them and ensuring that you have regular contact with your debtors and arrange payments. Sometimes you might even find the debtors haven't paid because there's a disputed item. It's actually good to go and meet with people and understand what the dispute is. And that might be just a dispute over one invoice and they're refusing to pay the other 5 invoices. So it's actually good to be in regular contact with your debtors and establish a criteria that you can actually contact each other and understand if they've got any issues with payments. Because as I said, sometimes it might be just one delivery mightn't have been received in full and they're refusing to pay, and arrangements can be made to receive part payments, if you like, while you're waiting for future deliveries. So really important to engage and interact with the particular debtors. The other thing is, longer the debt stays outstanding, and if the value is increasing, sometimes it becomes too high an authority for a particular person to actually approve that payment. I've been in a situation where a debt grew significantly above the manager's level of authority, and then that manager wasn't able to pay the debt. So you actually need to make sure your payments get received regularly, because they might ultimately be too large for that manager to authorize, and then you'll go into the situation it might actually have to go to a board member for final approval. So again, another delay. So regularly keep on top of your debtors. And as I said, the auditors will usually come through and review each debtor item and recommend any provisions where there's any doubt over those. In the loan area and the liabilities, you need to be very aware of the repayment terms. I'd encourage people to have a register of their loans, because the register will show the terms and conditions, but it'll also list out any security provided over those loans. So if you've got a particular land or buildings that you've mortgaged to achieve the loan, needs to be very, very clear of which of those land and buildings has been mortgages, in case you do need to realise them. And here's the other important slide. Okay, so in ASIC and all the legislation requirements, there is a duty to prevent insolvent trading. If you commit an offence if the association incurs debt while it's insolvent or becomes insolvent by incurring the debt. There needs to be reasonable grounds to expect the organisation would not become insolvent by incurring the debt. Some of the case law in that area and situations have been if an organisation enters into a huge marketing campaign with the belief that that will actually provide the organisation some resources, they shouldn't be entering that debt if they're already insolvent, or if that marketing campaign doesn't achieve a benefit and they would remain insolvent. So usually that will occur when the particular marketing supplier comes to collect the debt, then they would be looking at who to challenge because it was incurred while they're insolvent. I won't go through each of the sections, but there's a number of sections involved in this area. Okay, so in the understanding of the income and expenditure within the P&L, we encourage people to use cost-centered reporting, because then you get an idea of which areas you've spent the money in, and if that's money spent is actually what you budgeted for. So as I've said, if you're running a big event that's coming up, it's good to set up a cost center where that event will go into, and the cost center might be marketing. It's good to actually have a project allocated to that particular event as well, and the project then would be reported actual versus budget, or your forecast for that particular project. So the other usual cost centers are probably if there's a HR or payroll cost, because there's a cost of running your payroll systems. If you're employing people, there might be some recruitment costs, and generally your staff costs would be allocated to the cost centers in which they work. So if they're a finance person, you might have a finance cost center. If they're an IT person, you might have an IT cost center. So they're very helpful if you have the cost centers, because when you do the following year's budget, the actual costs incurred of each of those cost center can be adequately and accurately set up for a budget for the following year. It also gives management an idea of which areas they want to spend more money in. There might be periods where management and in conjunction with the directors agree that there might be a bit more to be spent on the IT section. So you might be upgrading your IT systems. So it's good to have that cost center in place and the costs involved in doing that upgrade. The other interesting part is actually the cost centers need to have all the direct costs in there. So if you're running a big campaign and you employ a marketing expert to run a campaign, the direct costs might go into or will go into the cost center of marketing. But there might be some indirect costs which need to be understood, where the marketing person uses 25% of the resources of the admin person that works for the CEO. In that way, I think you need to just record that as the total part of the project. So if you do another similar project, you don't just budget for the direct costs, but also the indirect. Okay, we've touched on budgets. So the starting point, obviously, for a budget setup is actually having a planning day. In Associations Forum, we're very fortunate that we have John Peaker, who's one of the experts in planning days and runs them for another number of organisations. Without knowing about the planning, how can you budget? So it's important that plans get put in place. Usually we encourage people to have a day or half a day set aside to run through those plans. And once you actually have agreement on the plans and set a budget, you'll then understand the financial resources you need to achieve that budget. That's a good way to ensure that you have no surprises during the year if you've budgeted and forecasted accurately. As I've touched on during COVID, boards are requesting more and more updates and forecasts. Previously, you might have a forecast of your cash till the end of the year. Board members are really asking of how the cash is going at even next quarter or the quarter after. So there's a lot more forecasting being put in place and reporting. So as we've touched on, the budget shows the financial history. The budget will help you achieve a good outcome if you understand what the history of the organisation is. So it's no point in budgeting for revenue that is going to grow tenfold if that's never been the trend in the past of the organisation. That's why it's important to understand the 5 and 10-year results. One of the things that we recommend is good to have what's called a results on a page, where you include the revenue items and key revenue, such as events or marketing campaigns, any of those items. And that will show which years you incurred them. You might actually not have a particular revenue growth in one year. You might delay the event for the second year. So it's important to understand the trends and have a results on a page which spreads over the period of a 5 or 10-year basis. And also down the bottom of the results on a page, you'd have revenue, you'd have the expenses, the ultimate profit, but you'd also have a non-financial numbers, which is the membership levels at each of those years. So you can see if there's any trends. You know, if you had 1,000 members in year 1 and you're at year 4, you've got 1,500, you might forecast an even better growth for the future periods. And staffing levels, because the staffing levels might go up and down depending on what projects you have in place or which stage of the organisation you're at, whether you're in a growth stage or in a maintenance stage. And this is an example of one of those. So we've got the income and expense, profit and loss, equity, and then you'd put underneath it what your cash balances in each of those years, what your total assets were, and some of the ratios and members numbers. So your ratio might be profit as a percentage of revenue, employee costs as a percentage of revenue, or employee costs as a percentage of ultimate profit. So it's good. You can expand that to whatever ratios are unique to the organisation. Some organisations might be very, very, very interested in what their marketing spend per sales is or something like that. Healthy finances obviously mean that you're going to be able to grow the organisation. If you've got a stable organisation, you may be able to take risks that you wouldn't take. Interesting enough, during the period when you actually have a stable environment and you're growing, board members are likely to push for other revenue or alternative revenue streams. If they feel that the organisation is struggling, obviously then they usually batten down the hatches and really will be reluctant to approve any major changes in the organisation. So important to actually have a good and stable environment to build on and to try and develop into a growth stage. Within the authority of the finance fundamentals is a key thing, which is the financial delegations. I can't stress this enough. In the cases that we'll discuss later, where they've got into trouble is via the financial delegations, where they either weren't in place or they weren't operating. Because one of the important things is making sure that if you put a delegation, and that might be a delegation in the amount the CEO is authorised to spend without coming back to the board, the amount of managers spend on projects, or travel spends. If these are not being adhered to, that's where organisations get into trouble. And also if people are doing workarounds, such as splitting invoices or making 2 separate payments for things that should have been approved once. I can't emphasise enough, the financial delegations are in place. And what happens is usually every year, if you have an audit and risk committee, they'll review the financial delegations and ensure they've been properly acting or understood. The key part in financial delegations is that they don't interrupt the business and actually put a hamper on running the business. So really important to have financial delegations that are operating effectively, because otherwise you'll encourage people to do workarounds. So as I said, they need not to be a stranglehold on the business. Okay. If you don't have a finance and audit risk committee, they will generally go straight to the board for approval of the delegations, but there should be an annual approval. Okay. And the auditors are a very important part of reviewing those delegations. In amongst the finance, audit and risk committee, it's important to make sure that you appoint a chair. In the past, a lot of organisations refer to the person that runs the finances as the treasurer. We'd encourage organisations to replace the use of the name of treasurer. That's a very old name. It also doesn't reflect the fact that all board members are equally responsible for understanding the finances of the organisation and for any debts incurred. You will have seen probably in the past where you're in a board meeting and a finance discussion comes up and everyone looks to the volunteer treasurer for answers. Under the company's code, every director is responsible to have enough financial knowledge to form an opinion and form an adequate discussion on what is being approved. And if they don't, they can actually seek advice, and the advice should be paid for by the organisation within a reasonable limit. So really important to encourage you, rather than you have a treasurer, have that person's allocated name as chair of the Audit and Risk Committee. And obviously, as we've said, is within that Audit and Risk Committee, it's very good to have a finance person or someone with financial expertise. Okay. As we've touched on, the auditors are very important in the phase of looking at delegation levels and reviewing that what has been agreed by the board is being
Steve, sorry,
yep.
Steve. I think we had a question about what if it's not in the Constitution?
What's not
on your previous point? Matt, would you like to clarify?
Yeah, thanks, Kathy. If it's not in the Constitution, that it's set out that we have a president, a secretary, a treasurer, etc. Do we have to go to an EGM to get that changed or update the Constitution to make that change?
As in, your Constitution doesn't refer to office bearers?
Yeah, it doesn't include a finance audit risk committee.
Oh, no, you wouldn't need to change Constitution. The board can just do that. Yeah.
Okay, great. Thank you.
All right. Back to you, Steve.
And I think Kathy does a number of those updates to the constitutions. And in other organisations I've worked for, usually there's a regular review of the constitutions to ensure they've been adequately updated. Yeah. Okay. The other item that often comes up is discussions around not-for-profit taxation status. It's very important that within your constitution, just happen to be touching on it again right now, is that the objects include that you're not operating for a profit of the members and you're not going to distribute any funds to members. And lastly, that in the event of a wind-up, the surplus is transferred, like I said, to another like-minded organisation with the same objects. And as I said, it usually would be another social organisation. It might be a club in the same particular area of expertise or operations for members. Okay. The other key thing with actually employing people is if you're in a delegated not-for-profit or in have DGR status, you actually get some important concessions. So that's a good way to attract staff, because not-for-profits don't necessarily pay top market rates, but one of the conditions that helps people come on board is that they get benefits because they're not taxed on some of the fringe benefits items, and you might be able to arrange tax concessions for your staff. So I'd encourage you to seek tax advice on this if you're starting to employ people, because you actually get some real good benefits for some really good employees. Okay. Okay. The next slide is actually around cash accounting versus accrual accounting. Everyone gets quite nervous about when we bring these two topics up. The really good understanding of it is cash is actually taking up a cost or taking up an income amount or cash receipt or immediately, where accrual accounting looks at taking up over the period of time when if you're going to receive some revenue, you offset the cash costs that you have against that revenue. So in the example we've got here is a normal one. An organisation receives $600 right on the 30th of June for the next year's membership and subscription. So the organisation probably has 50 or 100 of these people putting in their money to pay for their ongoing membership. So the organisation on cash accounting basis would straight away take the cash at bank, and then take into account in the month of June and the 30th of June 2020 year, the receipt as income. So that's the cash reporting of it, very pure and simple. But it doesn't reflect that by that person taking up the membership, that you've got to provide membership service to them. And you've got to provide those membership services for the next 12 months because that's what they've signed up for. And that's what accrual accounting seeks to cover up. So, so it's really around membership services delivery that you need to take up the accrual accounting basis. During that time of the next 12 months, the organisation might, via membership services, provide legal representation to the particular employees, might send out standard policies and procedures and spend a lot of money upgrading those. So it's providing services for the next 12 months for which that person has signed up for. The services are not delivered right on the 30th of June, though they might be July, August, all the way throughout the year. And that's not reflected by taking up in cash accounting. Accrual accounting does it a different way. So the services, when they're received, the cash still goes into the organisation, but what you usually will do is you actually then record the fact that you've got a liability to the members to provide services. So usually what's called, you'll go debit cash at 30th of June, and you'll credit what's deferred income. And each of the months in the year, say for instance, July, you'll recognise 1/12 of that amount of that revenue you received, because there'll be costs coming in through July for those membership services. Likewise, August, you'll recognise 1/12 until you get to the end of the year and you've receipted all of the revenue for the 12 months up to $600, but you've also expensed all the costs that have come through during the year. Okay. So that's in a very short nutshell. Did anyone, I'll give you another example as well. If you're providing a big marketing campaign and you're paying a particular supplier, they'll send you the bill on the 30th of June, and they might send you a bill for 120,000. So you then say, okay, you've got to credit the cash you've got, but you might call it a prepayment. So you've prepaid this bill, and rather than recognizing an expense at 30th of June in that year, then you might, their campaign to grow membership or the marketing campaign might be also to run a course. So the courses that you engage in might be spread over the year. So each of the expenses will be coming through in each month of the year. So when you actually then, you will actually reduce the prepayment, credit the repayment in each of the subsequent months, and the expenses will offset it. So it's very much about matching revenue versus expenses under accrual accounting. Did anyone have any questions on that? It can be quite confusing, but it's the examples I've given you actually give you a little bit of an idea of the matching concept. It really shows the position of the organisation is realistically in, rather than overinflating the results, the revenue, if you take up the revenue in the previous year, or if you expense the costs in the previous year, you're actually reducing the organisation's balance sheet and P&L, because the costs actually should be spread over if it's a course they're running in the following 12 months or if it's a campaign. Okay. And importantly, some of the software packages actually automatically do a lot of this reporting. So they've been set up to pick up accrual accounting predominantly, and that'll be lots of systems like Xero and YOB. Excel worksheets are good up to a point, but it's really important to actually have a robust system if at all possible. The reconciliations that you need to provide through the software packages are important, and a lot of them do automatic recording of those reconciliations. So as we've said, it's not the treasurer that does the software packages and the reporting, it's the accounting staff or the people within the organisation. We also have some surveys and different information of the various software packages, and we can provide some background on some of those as well. Okay, we'll just do a recap a little bit on some of the information we've done to date. So just putting it out to the participants. To trade solvently means that an organisation must have liabilities that exceed assets, must be able to pay their debts as and when they fall due, must have cash greater than inventory, or D, have non-current assets that exceed non-current liabilities. So let's just have a pause. So it's actually, what does trade solvently mean? Obviously, picking the first one, you don't want to have liabilities that exceed assets in the ultimate term, because that's where you're heading into insolvency. Must be able to pay your debts as and when they fall due is obviously the correct answer, because that's key to making sure the organisation continues. Must have cash greater than inventory. They're both balance sheet items, so they're just a reporting item. It's always good to have non-current assets greater than non-current liabilities. But as we've touched on, non-current assets, you might take a time to actually crystallise and realise the value of those non-current assets. So that's not going to always make sure that you're solvent. Okay. Any questions on that? Yep. Okay. Next one is directors and officers have an obligation to rely on the treasurers or the chair of the audit committee to monitor the financial affairs of the organisation. B, only ask questions when they think they know the answer. Or C, if they do have an accountancy qualification, rely on others to do rely on the opinion of others, officers regarding the association's financial capacity. Or D, be familiar with financial fundamentals and financial affairs of the business and keep informed about the activities and financial capacity of the organisation. So taking the first one, A, obviously, as we've said, all directors and officers are equally liable. You shouldn't be relying on any other person within the organisation. The board acts as a group, so it's ultimately the total board, so that wouldn't be correct. Obviously, if you only ask questions when you know the answer, you're not asking the difficult questions, because there's some parts that you probably don't know the answer, and that's part of being on a board, asking those questions. If they do have a accountancy qualification, still rely on other officers. The fact that an accounting qualification, in cases that have been brought up, that's actually been very damaging on the person that had the qualification that actually didn't use that to a level of their ability. So courts have found that even more damaging when they've had cases where they had fraud or different circumstances. And obviously D is the correct one. Be familiar with the financial affairs of the business and keep well informed. Usually that's via ensuring that the Audit and Risk Committee reports into the board on their quarterly basis at least, with the auditors attending and presenting when the financial statements usually annually are reported to the board. Usually you will actually have a section within that board meeting where the auditors provide a report on their findings of the audit of the financial statements. And that's a good opportunity for directors and officers to ask the auditors if they had any issues or concerns, and also following up the auditors what will be called an audit management letter points, where they may have found any deficiencies. They will report them under audit management letter points. And then it's the responsibility of management to explain to the board how they'll resolve those audit management letter points. And that might be by putting in more controls in place. It might be appointing a separate independent signature. In another organisation I was doing some work for, to make sure that they had independency on the signing of payments, one or two directors had involvements to where they were potentially working for another organisation that was going to receive grants. They didn't participate in any of the decision-making the grants, but they didn't also sign the bank transfer payment as well. It was signed by the CEO and an independent director. So making sure that you actually ensure that you have that level of independence. Okay, question 3. profit represents cash at bank, true or false? Everywhere, there's quite a lot of people, in particular the cash reporting area, would say it's correct. But cash is a good indication that you're being profitable and you're growing. But profit is really your income less expenses. And that's the bottom line, as they call it. And profit needs to be growing, as I've said, as does cash. They're certainly linked, but they're actually quite separate. Okay, the next number 4, which of the below is the correct response? As we've touched on, depreciation is part of running a business, part of buying assets, and assets deteriorating and reducing in their workability over a period of time. So you'll have property, plant and equipment, and you might depreciate them over 5 years or 10 years. Maybe in the IT area, you might buy IT equipment and they might depreciate much quicker because they might be a 3-year basis because of technology and that sort of thing. The key part to depreciation, just digressing slightly, is the fact of as assets get further and further written down, you need, and the depreciation grows, accumulated depreciation, you need, that's then a recommendation to reinvest in those assets. So if your plant and equipment started as being $100,000 in value, and after 10 years you're down to 10,000 in value, it's obviously directing you to spend more money on refreshing your property, plant and equipment rather than trying to continue on with that equipment. It's also quite a big downfall in organisations not spending money when the depreciation is high because they're not replenishing the organisation, and it's it's a recipe for failure as well. Okay, so depreciation is recorded as a cash payment in the cash flow statement. It's shown as a non-current liability, an increase in an asset amount, as an expense in the profit and loss statement. Depreciation is a bookkeeping entry. It actually gives an indication of how the organisation's assets are at a particular date. So it's an asset statement. So it's actually reflecting what the value of an asset is. As I said, if it's brand new, it might be 100,000. After 9 years and it's 10-year depreciation, it might only be worth 10,000. It's written down. So depreciation is not a cash flow item. It's a balance sheet style item in that way. A recorded, reflected balance sheet item. It's not shown as a current liability, and it's certainly not an increase in an asset amount, but it is an expense that every organisation has to put in its profit and loss statement because it's expense of running the business. Assets do deteriorate, and you need to write them down. Okay. Does anyone regularly review the value of their property, plant and equipment? Because a lot of things do get older. And do you have a capital reinvestment program? I know lots of organisations have a policy on and call it capital reinvestment, and they might automatically have in place where an asset after 5 years needs to be budgeted to be replaced. Did anyone have any comments on that? I think if you're in an organisation that property, plant and equipment is being heavily utilised, particularly in the farming or any of those areas, you need to be very conscious of the deterioration of assets over a bit of time and budget for replacement of assets. So it's important to link the depreciation to your next budget. In lots of organisations, they actually, if your depreciation is 100,000, they budget for 100,000 capital expenditure program. So it's like a matching principle in other ways, because the last thing you want to do is get to the end of a period and your asset is depreciated, and then you've got a huge spend that you haven't budgeted for, or your maintenance is being overwhelmingly spent. So the other key issue that you will see is if your maintenance starts to really grow exponentially, that's probably a reflection of the asset is so thoroughly depreciated that you'll need to replace it too. So rather than continually putting a maintenance expense through your P&L, you should be looking to put aside a budget for a capital expenditure program. Okay. So it's clearly an expense in the profit and loss statement that needs to be monitored Which of the following is not correct for employee entitlements such as annual leave and long service leave? Not required to be disclosed to the auditors. These are a liability in the balance sheet. Need to be split into current and non-current. Need to be calculated at current employee rates. This is not correct. So basically, A is, we'll come back to. B, these are a liability in the balance sheet. Certainly they're a liability in the balance sheet. You need to pay employees their employee entitlements, whether it be annual leave or long service leaves during various periods of time. And you need to encourage employees to take annual leave particularly. Otherwise, what will happen is once their pay rates change, the liability actually increases up. So they need to be split into a current and non-current, whether they're going to take them in their next 4 weeks in the next financial year, or they're deferring them till closer to retirement. And lastly, they do need to be calculated in current employee rates. So if you've got any employees that have got more than 6 weeks annual leave, it's good to encourage them to bring that down, because as you click over into the next financial year, they might be entitled to higher rates. So if they had 100 days annual leave, that 100 days, if it was a rate of just $1, and now it's $1.50, all of a sudden your liability is much higher. So you need to start bringing those down into manageable levels. And yes, you do need to disclose those information to your auditors. The auditors will do a review of annual leave, long service leave, and make sure that it's adequate when it's needed to be paid to employees. The other important area is this is another control space, ensuring leave forms are actually put in. Lots of organisations have numerous employees scattered around the countryside. I've seen in the situation in an overseas organisation, the general manager of a particular operation never put leave in up until a period of time. And then when he's about to leave, he actually asked for, I think it was 150 days leave because he'd never put anything in. So it was a payout requirement. So you need to regularly ensure that your employees are putting leave forms in and they're being authorised. The best way to cover this is actually in the audit and risk committee is have a report mechanism that shows last year the balances on the previous year's annual leave, long service leave by employee versus the current year's annual leave, long service leave by employee. So obviously some of them will increase because they'll get extra leave during the year, but some of them should also decrease by leave being taken. Okay. Finally, it's, in really simple terms, assets are things we own and the liabilities are things that we owe to people. A couple of little questions that are importantly about what we've touched on borrowings and liabilities. In the below, which of the following is most likely to be classified as a current liability? A bank loan, which is due to be paid in more than 12 months, a 10-year loan secured by a mortgage charge, monthly payments to a superannuation fund, or a long-term lease on a motor vehicle. Obviously, a bank loan, which is greater than 12 months, is not a current liability, and you encourage an organisation to ensure its loans are spread out over a period. So that's not a bad thing. A 10-year loan secured by a mortgage, again, it's not a current liability, it's a non-current liability, and it's actually spreading out the period that the organisation has to service that loan. The only key part is the fact that it's a mortgage over your particular asset. Monthly payments to a superannuation fund are a current liability. Obviously, each and every month, your employees would receive a superannuation from the organisation, and then that amount needs to be forwarded onto the superannuation fund. And lastly, if it's a 3 or 5 year lease on a motor vehicle for your staff members or for the organisation, it would again be classified as a non-current liability. Okay, reverting to a non-current liabilities, in the following, which of these are most likely to be classified as non-current liabilities, as I've said, it's better to have more non-current liabilities as current because it spreads out the actual payments that your organisation needs to make. A bank loan which is to be repaid in 5 years' time. Electricity and phone charges accrued and paid on a monthly basis. Accrued fortnightly, weekly charges payable by the organisation, or monthly bank fees. Obviously, number one is the correct one. The bank loan is to be paid in 5 years' time. Because you've stretched it out, you've actually pushed the requirement of that amount out into the remaining period of time rather than being due within 1 year. The only part that would be current would be the interest component that's payable on that loan. Electricity and phone charges are normal monthly payments, so not non-current liabilities. Fortnightly wages, obviously, because they're fortnightly, are not going to be more than a year, and they're current. And obviously, bank fees are regularly paid and incurred, and they're actually a current liability rather than non-current.
Steve, we have a question about monthly lease payments.
Yep.
Are they current or non-current?
So what you need to do is actually look at the terms of that lease agreement. So you would actually divide it up into the first 12 months would be current. And then if it's if it's a 3 years, the remaining 2 years would be non-current. So it's actually splitting the actual payment component up into the relevant periods. Okay.
Thanks.
Okay. It's very important, I've said, to stress about the liabilities, because if you can get more things into non-current liability, it makes your business able to actually service the debt a lot easier, and also make sure that your current assets are in excess of your current liabilities at all times. Okay. And as I've said, the other important part is understanding the security around any of those loans, because at some point in time you might want to sell those assets. And if you've got a security around that, you'd be delayed from selling those. Okay. Okay. I've just put in a couple now of profit and loss statements, balance sheets of various organisations, just to show some of the comparisons that happen. So in this one, XY Limited revenue statement, I've put in the actual year we're reporting on. You would always compare it against the budget year and the actual for the previous year. So the important thing with this organisation, it's actually done a realistic budget in lots of ways in the revenue, because as we've seen in sponsors and grants and even events, they've been dropping dramatically during COVID. So for instance, the sponsorship was 105,000 in 2019-20. The budget probably should have reflected a lower amount this year, because ultimately it was halved, because you weren't getting the sponsors, because you weren't running events and seminars. Membership fees, lots of organisations are trying to maintain their membership fees. There may be slight drop-offs because of giving those members if you like, a deferment and not asking them to pay, and just keeping them on the books for 12 months while they run through financial difficulties. So in this situation, membership fees probably shouldn't have been budgeted for an increased fee, because it's a tough environment, and that's reflected under the previous year's numbers. But like I said, organisations are using lots of different means and measures to ensure they keep their membership base ultimately till better times kick in and the members can continue with their membership. As we've touched on, the important one is events and seminars. This organisation reflected that there was going to be a drop from 55 down to 50, but weren't realistic enough into the amount of the drop. What we probably would be looking at this organisation is addressing, okay, if we know that the events are not going to happen, what things are we going to do to try and put in place more Zoom or non-face-to-face seminar type things to actually replenish the revenue that we previously had. So on the right-hand side of the actual 2019-20 column, you would have actually probably their actions to address. And importantly, alongside each one of those, you'd actually look at what you can do to address, and that would be brought back to the board. Okay. Any questions on those revenue items? I think the key in the current environment is making sure that you put in a realistic budget. It's no point in if the actual numbers are showing a decline, you need to start showing a decline in the budget that you're putting forward, because ultimately at the end of the year, throughout the year, you'll actually be reporting on variances rather than if you think there's going to be a 50% drop in certain parts of your revenue, you should put that in your budget because that's what you'll be judged on. And as I said, if you've got an actions column, actions to implement or address, that's your best way to talk to the board about what you can do to actually achieve that budget. I'd really encourage people in the revenue side to be realistic on revenue and making sure it's achievable. It's no point in putting a budget in that in the first month of the year of the budget year that you don't even get close to the budget number, because you'll spend the whole year chasing your tail explaining why you didn't achieve it. So budget should be realistic. You should always compare it against the previous year's actual, but have a really good understanding of the trends in the previous year. The previous year might have been going well for 6 or 7 months of that year, but the last 3 or 4 months might reflect where the budget should be because there has been drops for things like COVID. Okay. Conversely, on the expenses side, again, looking very closely at what the expenses were in the previous year, you put the budget together usually on that basis. But again, in a COVID situation, you would look at how you reflect those costs. And if your revenue is dropping in the previous slide, then you need to address it as well by looking at what expenses need to also reduce to ensure the organisation can continue to operate. So in this particular situation, consultants and contractors, previous year, they were spending 100,000. The budget was a good reflection that they wanted to cut down costs and bring them down because obviously the revenue had dropped. Unfortunately, there wasn't strong management of the consultant and contracting work. And again, they've been able to blow out. So again, a column on the right-hand side would need to establish what comments and a recommendation, the actions to be have. So in this particular situation, if during the year, and these consultants were starting to exceed the budget, there needed to be steps to take to address that. And that might have been about reducing the number of contractors on board, reducing the ability for authority levels for people to hire consultants, because it's no good hiring consultants if you're just creating a worse performance by the organisation, unless you're putting them in place to grow the revenue for the following year. The other key next item is bad debts. Obviously, the organisation was going quite well previously, had no bad debts. All of a sudden, 13,000 compared to none in the previous year. Again, a reflection maybe of a COVID situation or just a deteriorating economy. Very important that in the trade debtors, you manage effectively the collectible amounts of your trade debtors and try and keep your bad debts to a minimum. Okay. And the other part is if people are struggling, it's no point in completely writing off the debt if you can enter an arrangement where they can actually pay back by installments. It's better to get something on a slow basis rather than get nothing at all. And the organisations will appreciate that if you do provide that, because then they'll actually continue to probably trade with you once they return to some level of profitability or their circumstances improve. So it's very important to understand your trading partner's strengths and weaknesses. If it might be a short-term cash deficiency, but the organisation ultimately has large assets and property, plant and equipment, and they'll grow the organisation in the future, you might actually extend the trade terms and conditions. Obviously, events with a COVID situation or a drop in the economy, previous year was 59,000. Good work. They actually reduced the budget by half because of the change, and they've been monitoring it closely and keeping them under that number. The next one, employee costs. Obviously, previous year, quite a robust year, so they're able to play lots of employee costs. They recognise that the budget should be dropped because the income wasn't there to drive the organisation. But it's blown out slightly. So again, on a monthly basis, this would have been reported and should have had steps to address that, unless it was being spent to benefit the organisation in the future. Or the other things that could be going through employee costs quite often is any redundancy or retrenchment payments that weren't budgeted for correctly. Okay. Impairment of assets. As I've said, if some of the assets are deteriorating over a period of time and the auditors actually do a review, they may recommend there's an impairment of those assets and they'll need to be written off. And this case, they probably weren't aware or reviewing regularly their assets because there was some impairment. Okay. Ultimately, the organisation was budgeting and was trying to achieve a profit, but had a loss of 109. So again, very close attention to if you can't control the revenue, you need to control the expenses. Okay, just a balance sheet of an organisation. So good news on this organisation, the cash was growing 190 to 200. The interesting thing is in the debtors, where there's an increase in debtors provision, probably recommended by the auditors from 10 to 20,000, 30,000. So that's again monitoring your debtors conditions and terms. Inventory, 100,000, 150. The most important thing to check on the inventory is that it's not growing in value, and it's unfortunately not realizable. So you're really important to understand your aging inventory. If your inventory is getting very old and you can't sell it, then you might have to take steps to put a provision for diminution. So inventory should be regularly turning over, and like in debtors where you do an aging of debtors, you should be very conscious of the aging of inventory. Oh, sorry. Plant and equipment, as I've said, in this situation, the plant and equipment was worth 90,000. It's dropped to 60,000. Maybe time to start spending some capex to grow the inventory up again. Okay. Did anyone have any questions on the asset side there? Particularly, I think I'd encourage you to be very conscious of your inventory levels as well. Okay. On the liability side, trade creditors have grown slightly. It's always important to monitor those. You'd like them to be a bit higher if you can stretch out the payment terms, because that's to your benefit. But if you're deferring payments and not making payments to your creditors, that could ultimately come back to bite you if they all start trying to collect at the one time. So you've got to be very careful that you're not stretching too much. And sometimes there's penalty. Sometimes there's benefits in payments on payments in line with terms, and you might get discounts for doing that. Employee entitlements, as we've touched on, in this case, it was grown from 75 to 95. What you'd be looking at is encouraging staff to take leave if lots of staff have got significant levels of leave built up. The next one is borrowings. That's not a bad situation because your borrowings have increased as long as it's, it's not a good situation because they've increased, but the reflection is it's come out of the non-current area where they've dropped down as well. So, or they've increased as well. So really important to monitor the borrowings because you want to actually move them into more than 12 months rather than less than 12 months. So in this case, 100,000 might be a significant increase. It might be the fact that the terms and conditions said and clicked over in the following year as you're coming into that year. So you need to try and either renegotiate them maybe if you can't service them.
Steve, we had another question from Peter about tax liabilities. Where do they sit GST and payroll, for example?
So they would be under probably you'd have the GST probably under trade creditors or provisions, and they're a current liability. Okay, because you're going to the tax department won't let you stretch out your payments. I can guarantee you that. So, and then what was GST? What was the other one, Kathy?
Payroll.
Payroll. Yep. Again, they would all be within the current liabilities. If they're a large enough category, you might separate them out. but usually they would fall maybe into trade creditors, or if you have another category called provisions. Okay. As in these balance sheet items, these are very, very basic balance sheet categories. If the assets or liabilities are significant, you would tend to actually disclose those separately, or not if you don't do it in the front of the balance sheet or in the assets and liabilities sections of the front of the balance sheet, you do it in the notes to the balance sheet further into the accounts. So these are very basic type reporting ones. Okay. Did anyone have any questions on the P&Ls or balance sheets as well? As I said, it's actually really important, if you can, to put columns of analysis alongside the 3 columns that I've suggested, and actions you're taking, and highlighting if there's any major variation. So if you've got something that's moved by more than 10% in a P&L item against budget or last year, you should be disclosing that maybe to the directors so they get an understanding. You would hope the directors ask questions on those ones to show that they're actually what. Sometimes it's good to actually put some things in to see what questions you will get by highlighting certain things. And also in the balance sheet items, if it's a material movement in the balance sheet from last year to this year, it's usually not against budget. Usually it's against last year to this year. You need to just understand why that's moved. And that might be, as I said, you've collected a bad debt, so you've actually you've reduced the balance sheet trade debtors. If it's an increase in liabilities, it might be good news that you've actually been able to say to one supplier, rather than paying in 7 days, we'll pay 30 days. So that's not a bad thing as well. Okay. Okay, in summary, obviously we've talked about not-for-profits, not the greatest word in the world, but surplus is a better word to use, and people should be encouraged to achieve a surplus. When you have a board meeting, it's very good to actually report back after the board meeting to the staff on how the board meeting went and what the actions come out of that board meeting, because quite often the staff are involved in actually completing those action items, and they'll get an idea of how urgent, or if they have the time and resources to complete that action, and can actually help you in the implementation. So it's good to inform the other staff members rather than just keeping them in the dark. And that way you actually grow your people as well, because they can be well informed, and they'll actually want to work much harder and diligently for the organisation if they feel like they're valued and informed. Always start with the balance sheet, as we said, because that's the focus of what your net assets are, focusing particularly on cash and the asset values. Always use activity-based centre reporting or cost centre and project reporting, because that gives a clear indication of where you're spending the money, and is very good for budgeting purposes the following year. It's important to have timely and accurate financial statements. In some of the cases that have come up recently, the ones that have had fraud or other issues is usually reflected in the fact that they were delayed in forwarding financial statements. The auditors were not given adequate access to information, and everything wasn't timely, and it certainly wasn't accurate. One of the other key criteria in any organisation is making sure you manage the funds as if you're own. You know, if you're working for an organisation, you should take into account what you would do as a reasonable person to try and assist and help them in making sure the organisation continues on a profitable basis. Yeah. As we've said, if you've got a particular project coming up, a large project, always allocate the staff resources and costs against that project, and make sure it's an accurate recording. If your organisation is large and a reasonable level, it's good to have a finance and audit and risk committee, and that also then assists the board in performing their functions. Importantly, the board needs to be involved in the high-level strategic part of the business. They're not involved in the day-to-day approving of each and every transaction or receiving reporting or information on each and every transaction. They only want to be, if you like, at the helicopter level, the strategic level, and leave the functioning of the organisation and operations to management. Important to benchmark your association, and we have lots of surveys that we can assist you in. And lastly, always record and provide financial trends over the last 5 years. That's particularly important when you do an induction of a new director, and also then gives you an ability to talk to other organisations such as banks and investment institutions if you're looking for loans or any borrowings that you're after.